Hello everyone, welcome back to the second part of this lecture on multiples, and here I want to talk a little bit about a multiple that's used a lot in the financial industry, namely the PE ratio. So note that this is an equity multiple, so it's the price per share over the earnings per share, and as such McKinsey doesn't really go in depth into this multiple. So why do I want to focus a little bit on this multiple? Well, because it's so widely used in the financial industry, and because you can learn a lot from the PE ratio and also apply it to enterprise value multiples, which is a thing that McKinsey focuses more on. So with that said, let's start with the PE ratio, see what we can learn, and then slowly build our way up to other types of multiples. So PE multiple, it's all in the name what it is. So PE multiple, the price per share over the earnings per share. So more or less, how much are you paying for certain earnings per share? So are you paying 6 times the earnings per share? Are you paying 7 times the earnings per share? Are you paying 50 times the earnings per share? And that is more or less the intuition. So how long more or less does it take for you to get your money back without without thinking about what the discounting is? If the earnings per share are exactly what they are today, what are you paying to? How many times those are you paying those earnings in terms of your share price? There's all these different variants of the price earnings ratio, so make sure that if you're looking at the PE ratio, that you're comparing apples to apples, so that for instance, if you're comparing current PE ratios, make sure that you are actually comparing current PE ratios and not comparing them to, let's say, trailing PE ratios. So trailing PE ratios, typically what is the share price compared to the earnings in the past 12 months, forward what is the price per share over the earnings per share for the expectations of the next 12 months, and the current PE ratio, well, somewhere in between. You can have primary, diluted, partially diluted price earnings ratio, so all has to do with how much do you expect or how much do you take into account that the earnings may be diluted if all the employees exercise the options, or maybe you do not take that into account. Again, not really a clear-cut way to say, hey, you should always take dilution into account, you should not take dilution into account. It's just to say, make sure that if you're comparing PE ratios, that you're actually comparing either primary PE ratios or diluted PE ratios. You can have before, after extraordinary items. You can use all these different types of accounting rules. So what is included, what is not included, and yeah, so not really a clear-cut way to say, hey, you should go one way or the other, just to say, hey, make sure that you're looking at the same thing. So here I took some data from Aswad Damodaran to give you a little bit of an idea of how these PE ratios change when you're looking at current versus forward versus trailing PE ratios. And this is not a picture to show you like, hey, the forward PE is always bigger or smaller than the trailing PE. It's just to show you that, hey, these numbers can differ by a lot. So for instance, here in metals and mining, so if you're looking at overall current PE ratios, that's about 40, forward PE ratios are about 30, and trading PE ratio is about 150, 160 or so. So that's about a five-fold difference or so. So this can really matter a lot. So just to reiterate this point that, hey, compare apples to apples, because otherwise you will find these big artificial differences. And also, and here this fell a little bit off. The title of the graph, it's all in the purple area. But this is the difference between the current PE in the US versus the current PE in Europe for different industries. So here you see that even for these markets which are superficially very similar, so highly developed markets in the Western world, Europe versus the US, the same measure, namely the PE ratio, in the same types of industries can still differ by a lot. So for instance here, real estate investment trusts, so it seems about a twofold difference or so, while healthcare products, almost a three times difference between the US and Europe. Again, not to say, hey, PE ratios are always higher in Europe, are always higher in the US. No, this is just to show you that how much even taking like a geographical focus can affect your measure for the PE ratio that you're actually finding. So make sure that you keep this in mind, that yeah, that if you're comparing a multiple, that this may affect the numbers that you're actually finding. So yeah, just make sure to triangulate. So look at the same data from different perspectives, and then I'm sure you will do fine. So let's talk a little bit about some fundamentals. So what drives the PE ratio? Because in principle you can say, hey, high PEs means that stock is likely overvalued because, well, you're paying a high price for certain earnings. Low PE means that the stock is likely undervalued because you're paying a low price for its earnings. But of course, these stocks with these different PE ratios all have different characteristics as well. So here I want to talk about what are the fundamentals that drive this PE ratio, so that we can get a better understanding of, hey, why is this PE so high, and does it make sense that PE is high or low, or what should we look for when we see a very high or low PE. So let's start with the dividend discount model. So dividend discount model says the P0, the price of my share, is equal to some stream of all its future expected dividends. So in this case, that's going to be div1 over RE minus G. So we assume this constant growth in the dividends. Or what I can also write down, so this is 1 plus G times div0 over RE minus G. And then let's turn this into a trailing PE ratio. Note, by the way, that McKinsey prefers using forward PE ratios compared to trailing PE ratios. I fall more in the camp of using trailing PE ratios, because trailing PE ratios, at least you have measurable data. So you know exactly, hey, what was my net income over the past period? You know exactly what is your price currently. If you're using a forward PE, then you have to estimate, hey, what will my net income be? But there are, of course, also arguments to make for using forward PE ratios, where you say, hey, we care about what the future brings because we're in finance. So that is a good argument to say, yeah, maybe use forward PE ratios. Also, yeah, I'll show you in just a minute why using forward PE ratios makes this type of formula a little bit less cluttered. But this is just to say that, yeah, McKinsey likes using forward PE ratios, which makes sense given that we care about the future. All right, so let's keep going. So here, let's estimate trailing PE ratio, so price over the EPS. So we just calculated the price, so let's divide by the earnings per share at time 0. And let's rewrite this slightly, so 1 plus G over RE minus G times div0 over EPS 0. And what's nice about this part right here? Well, that's the dividends per share over the earnings per share. So if we multiply this with the number of shares, so let's say here times n and here also times n, then we have the total amount of dividends that we pay out over total net income. So this is the payout ratio, right? So it's the amount out of the net income that we're paying out to our shareholders in the form of dividends in this case. So let's rewrite even further. So this is 1 plus G times the payout ratio over RE minus G. And then we have the same formula that we have right here. We can even rewrite this further by saying, hey, this is exactly the same as 1 plus G times 1 minus the reinvestment rate. Because, well, of course, what we're not paying out, we're reinvesting back into the firm, so that we have this formula for our price earnings ratio, P0 over EPS 0. Note that if you're using a forward price earnings ratio, so taking price currently over the expected net income over the next year, this will become 1 minus the reinvestment rate over RE minus G. Because, well, you have the same formula as you have right here, but you're dividing by 1 plus G. So it becomes a little bit less cluttered, which is, I suppose, an advantage of using forward PE ratios as well. But for now, let's focus on this trailing PE ratio and what the fundamental drivers are right here. You can also write this down slightly differently by not focusing on the dividends, but focusing on the free cash flows to equity. Works in much the same way, where you again say, hey, I know that my price at time 0 is my free cash flows to equity at time 1 over RE minus G, which is equal to my net income times 1 minus the reinvestment. Minus the reinvestment at time 1, of course, RE minus G. And then if I divide both sides by EPS 0, so again here EPS 0, then I have here my net income per share. So my net income per share. I have here my earnings per share. So this becomes 1 plus G times 1 minus the reinvestment ratio over RE minus G. So the exact same as we had before. Now, what is nice about this? Well, first of all, you can use this to kind of estimate your PE ratio if you have some information about the firm. So suppose that you have been asked to estimate PE ratio for a firm. So we know that PE ratio is 1 plus G times 1 minus the reinvestment rate over RE minus G. And if we have following characteristics, what is your rounded estimate for the PE ratio? And here I get a value of 15. So if we have a payout ratio of 50%, 0.5 times 1 plus G, so times 1.04 over return on equity. So return on equity of RF plus beta times the market risk premium. Then I get return on equity of, well, about 0.075. And if I then punch in all those numbers, I get a PE ratio of about 15. All right, let's continue because, yeah, in principle, it's nice to be able to get the PE ratio from these fundamentals, but it's also nice to be able to apply this. So suppose we're reading this equity research report on a certain sector. So these are all all these bottlers and all these soft drinks and some alcoholic drinks. And this analyst says, hey, two companies, so in this case Andres Wines and Todd Hunter International, have very low PE ratios. And if we look through the data here, yes, it seems like those guys, they have the lowest PE ratios. Now they're saying these are undervalued because they have low PE ratios. Would you agree? And here I would say let's not agree, because if we look at the expected growth, then they also have very, very low growth. So does that make sense? Well, we just looked at the PE ratio, 1 plus G times 1 minus the reinvestment rate over RE minus G. And here you see that if your growth is higher, then this will also lead to a higher PE ratio, right? So in the numerator, higher G means higher PE ratio. In the denominator, higher G means lower denominator, so higher PE ratio. So the PE ratio is positively affected by this growth. Does this make sense? Well, yes, it makes sense, because even if you have very low earnings per share right now, you may want to pay a lot for those earnings per share, because you expect higher earnings per share going forward. The higher is the growth, the higher is your expected earnings per share somewhere in the future. So this means that you will likely want to pay more for this share. So it makes perfect sense that more growth means higher PE ratio. What about other ratios here that you can think of for these fundamentals that drive PE ratio? Well, if we look at PE as, so that is 1 minus the reinvestment rate, then we also see that a higher reinvestment rate means, well, lower payout ratio, which means lower PE. So higher reinvestment rate means in general a lower price earnings ratio. Does that make sense? Well, yes, because higher reinvestment rate, if everything else is held equal, means that this company has to reinvest a lot back into its firm to generate a certain amount of growth. So it's relatively inefficient in terms of generating growth. So that means that, yeah, you will likely want to pay a little less for this firm because, well, you expect that they will they will inefficiently increase their growth in the future. You can also say that because we know that reinvestment equals growth over return on invested capital, that if this reinvestment rate is very high and growth is equal, then that would mean that our return on invested capital is very low. So higher reinvestment rate would typically mean, yeah, inefficiently generating growth, relatively low return on invested capital, so a company that I will not want to pay as much for. Then what about the discount rate, so the RE? Well, RE, how is RE affected? Well, RE pretty much consists of two things. So the first is risk, so operational risk, and the second is leverage. So higher leverage means higher return on equity because, well, the equity is riskier, you want to be compensated for that risk. And higher operating risk also means the equity is riskier, so you want to be compensated for this risk. So higher risk means typically lower price earnings ratio. Well, why is that? Well, because if the security is riskier, then well, you want a higher return for it, so you will likely assign a lower price to it. So you don't want to pay as much for the earnings because the earnings are riskier. So again, makes perfect sense. So if you hold all other things equal, higher growth firms will typically have higher PE ratios, higher risk firms will typically have lower PE ratios, and firms with lower reinvestment needs will typically have higher PE ratios. Of course, in reality, other things are hardly ever held equal, right? Because, well, typically high growth firms tend to have very high risk and also high reinvestment rates. So typically you will find that these high PE firms, so that these factors more or less balance out a little bit. And that's exactly what you see if you look into the data. So here I took some data again from Domodaron. What can I say? The guy collects the data and which are easy for me to export from his site. And then I plotted the expected growth on the vertical axis and the PE ratio on the horizontal axis. And indeed, you see that if you look through your eyelashes, that yeah, there is this positive relationship. But I always get a little bit skeptical if you can just as easily just draw a little horsey out of the data as you can make a trend line, right? So yeah, happy horse. But here you also see that yeah, that merely looking at one factor is likely not going to be sufficient. So for instance, here you see this industry which has a very low PE ratio, a very high expected growth. So what could be the case here? Well, it could be that this this industry as a whole is underpriced, so undervalued, but it could easily be that RE is very high, right? Or that reinvestment rates are just very, very high. So a bit hard to say exactly whether or not this is underpriced or overpriced, and this is exactly the lessons you should take from the PE ratio. Because if you're looking for the perfect undervalued asset, you would have one with low PE ratio, so it's undervalued, it's cheap, that has high expected growth, low risk, and low reinvestment rates. In other words, it's cheap without having a good reason for being cheap. So in the real world, this never happens, right? So this means that if you ever find an asset that has a very low PE ratio, that is underpriced, then ask yourself, hey, what is the expected growth? Maybe the expected growth is very low. What is the risk here? Is the stock super risky, or how efficiently does this company generate growth? And if you, after answering these questions, still find that this company is undervalued, then maybe then you have a good reason to say, hey, it's really undervalued. So the story, the lesson here about PE ratio is more about, hey, be careful with assuming too quickly that something is undervalued or overvalued, and be mindful of the fundamental values, the fundamentals that drive this multiple. Next part of the lecture, I'm going to talk about some other equity multiples. See you there.